All right. Welcome in. I'm going to be talking about hidden inflation and basically making the argument that there's a lot of hidden inflationary pressures in the US economy that are harming consumers but aren't showing up in the government recorded data. And first, I'm going to start with kind of the importance of anecdotes. Most Americans right now are really unhappy with the economy, and there's been a lot of news articles talking about that. Even though the data on the U.S. economy is shown to be super strong, and there's a good interview with Jeff Bezos from Amazon that basically talks about how at Amazon they had a lot of data that showed that their customer service was really good, even though they had a lot of complaints about their customer service, and they ended up just calling the customer service line in a meeting and found out that it really wasn't very good, and they had a long wait time, and it basically just goes to show often if you have anecdotal evidence that something isn't very good, and people are complaining about it, that's probably correct, and it's your data that's wrong rather than people are just making stuff up. So obviously I have a lot of data that I think backs up the point that I'm trying to make, but I think it's also just important to recognize that if people are saying stuff's messed up in the economy, stuff's probably messed up in the economy. So I'd say the best evidence for there being hidden inflation is if you just look at the amount of inflation in the last 10 years. It's reported to be 33% from the CPI data, but if you look at the amount of money in the economy, which they track in the M2 money supply, you can see that that's gone up 90% over the last 10 years. And so that really doesn't make any sense, because inflation is money printing, because naturally in the economy there's deflation. And this is because if you have the same amount of money in the economy, but every year the economy produces more goods and services, technology advances, everything gets more efficient, then you should naturally see deflation. Your money should get more valuable. And so because deflation is worse for an economy than inflation, the government prints money to try and keep the value of the dollar constant, which leads to inflation. And there's no doubt that inflation totally sucks, and you really don't want your money to be worth less, because that's only a space away from being worthless, right? But it's basically a necessary evil. And so the primary money printer is mortgages, and this is kind of a feature of like the way we do banking in the United States. We practice something called like fractional reserve banking, which you're welcome to research, but I'm not really going to get into it because it's kind of complicated. But basically, what you need to know is when a private bank makes a mortgage loan to help you buy a house, they're just like creating that money out of thin air, essentially, which is how like new money gets put into the economy. And the overwhelming, not overwhelming, but like the majority of the money put into the economy, new money, is through mortgages. And so if you look at the consumer economy, which is what the CPI tracks, right, it's a pretty simple loop, right? And if you get that new money printed in form of mortgage, right, and it goes to consumers who then spend that money on goods and services, that increased demand then leads to more hiring and increased wages, which then of course goes back to consumers, and it just leads to this cycle, right, that leads to inflationary pressures, right? And there was a big problem in kind of the 80s where they just had continued inflationary pressures, right? Because you increase wages, which increased the amount of money, which increased prices, which increased wages, and it just kept cycling. And that, which is why like the federal funds rate, which we'll get into later, is used by the Federal Reserve to kind of control inflation. And so and so like that's what that's the consumer economy. There's also sort of an alternate economy, which I put in quotes because it's not really an economy. It's just like flows of money through mostly assets. But a huge chunk of money is caught up in kind of this other system, and increasingly, less money is in the consumer economy and more money is in this alternate economy, which is sort of, which is what's causing the hidden inflation, because if you put more money into the economy but it doesn't go to the consumer economy, you're not going to see it in the consumer price index. And so basically, right, you have your wealth holders, right, and the mortgage money printer, goes to the wealth holders, right, which is just people in the economy with money, right, and they can either put it into the consumer economy and spend it on things, or they can put it into assets, right, which can be stocks, crypto, real estate, art, or whatever, but none of those assets actually store money. Like there's actually, there's no money in the stock market, which is, it might seem kind of counterintuitive for me to say that, but when you think about it, when you buy a stock from someone, right, or you buy a house from someone, you're just giving them the money, right, and then they're giving you the asset, right. The money isn't actually stored in the asset. When you buy a stock, the money doesn't go into the stock market; it goes to whoever you're buying the stock from, and so all of that money then ends up either just sitting in bank accounts, right, which is most of it, which then of course then fuels more mortgages and bank lending and money printing, right, which just continues the cycle. But also the money can end up in treasury bills, and of course the government just continues to borrow increasingly large sums of money, right, and the debt is increasing by like $1 trillion every year, which then largely goes to fund government spending into healthcare and the military. Right? Those are the two biggest spend categories. And so really, like this alternate economy is a huge portion of the economy. And if you go, there's a lot of evidence for that, because if you go and you look at like the healthcare industry, for example, right, which is receiving a lot of the money flowing through this system, right, by all metrics, right, the healthcare is the fastest growing sector, of the economy in the U.S., right? If you just Google like highest paid occupations, they're pretty much all healthcare, other than CEOs and lawyers. Like it's a great time to be in the U.S. economy working in healthcare. Like the economy feels great. You're making tons of money, right? Things are good. And really, like those anecdotes from earlier where people are saying, oh, the economy's not so good, even though the day looks good, right? That's not, those aren't the healthcare people, right? Because they're not getting, kind of screwed by hidden inflation. They're essentially benefiting from it. So if we go and finally look at the consumer price index, right, which is of course what's supposed to track inflation, I'd say the consumer price index tracks a bunch of items, but of course, if we go back to our chart, right, the main one is of course the mortgage money printer, and that also, sort of affects both economies, because that's the that's the money where the money printing also that can also flow into the consumer economy, and then it's also included in the CPI. So that's probably the most, shelter listed here is the most important one, and there's pretty good evidence, I would say, that this number is getting underestimated, like pretty solidly, because if you see here, it says owner's equivalent rent of residences, which is not the home prices. And so you would think, well, if they're tracking inflation, they should be tracking inflation home prices, but that's not how the consumer price index works. Instead, they track something called owner's equivalent rent of residences, which is essentially how much you would pay if you were renting your own house to yourself, even though you own the house. And as you can see here in this chart, the cost to buy versus cost to rent is a huge difference right now, which really doesn't make any sense. Like the cost to rent and cost to buy should be about the same. And I would say that this is really good evidence of kind of hidden inflation, because you're seeing huge hidden inflationary pressures in asset prices, which is the cost to buy, right? Like home prices. But you're not seeing those same in the cost to rent, which is of course the consumer facing economy, essentially, right? And if you look at the other times where this has happened, well, there was the huge housing bubble in 2006, and it's still possible that there's some sort of housing bubble today. But I think, if you look at the data, I don't think we're really in a housing bubble like 2006. I think it's much more likely that it's just because of hidden inflationary pressures. And of course, then the other bit large time was 19 near 20% mortgages, which of course is not at all what we have today. So essentially, this doesn't make any sense, and also leads to the consumer price index not accounting for the huge surge in home prices recently. So just to basically summarize, the consumer price index will only show the money printing if the money reaches consumers and reaches that consumer economy that we talked about earlier. And if it just stays in assets and stays in bank accounts and stays in treasury bonds, loans to the government, all that sorts of thing, or stays in kind of parts of the economy that aren't consumer facing, right? Because like money can hit the economy, but if it just trades around between a bunch of businesses and never reaches consumers and doesn't reach the consumer goods prices that the CPI tracks, then it won't be accounted for. As well as, an important point to note is the average home buyer is age 56, which really just illustrates like a lot of the asset buying, is like second and third homes. It's stuff like that, right? It's not, people buying their primary residence or their first home, right? Huge chunks of the economy are no longer able to afford a house, which is really changing the economy drastically in a way that, is unintended and is leading to kind of hidden inflationary pressures, right? And unintended consequences. So yeah, of course, looking at the consumer economy here, just to kind of summarize, right? Like if the money doesn't reach the consumers, right? Nothing. I mean, this just doesn't happen, right? There's no wage growth. There's no inflation in goods and service prices, right? And I think it's kind of important to note too. Obviously, like inflation sucks because your money's losing value, but you also do want your wages to go up, right? Because everyone wants to make more money, right? So, and if your wages go up, most goods and services, the primary driver of the price is the wages, right? Of the wages of the people making the goods and services, which of course is super intuitive, right? So for your wages to go up, prices do also have to go up as well. Ideally, wages would still go up faster than the prices of goods and services, and they're becoming wealthier. But it's pretty much impossible to have wages go up and have the price of goods and services stay the same. But looking at the alternate economy, you can just, right? You can dump infinite amounts of money into assets, right? Into bank accounts, into treasury bills, right? That and print a bunch of money to people as long as it never touches the consumer economy from a like CPI inflation perspective, right? And like we said with assets, right? Because the money isn't stored in the assets, you can have money flow into assets, flow out into bank accounts, right? And then flow right back into assets, right? Or you can buy stock, sell stock, buy real estate, buy crypto, just right, and just keep trading the money between hands because it's not actually stored in anything to just drive up asset prices kind of to infinity. And that isn't to say that any of these assets are super valued. Although I'm not going to speak for crypto because I don't, that one could very well be overvalued. But like stocks and real estate are based on kind of the fundamentals, right, and the forward earnings with the expectation of a return. So I don't think that either of these are kind of ripe for a crash or super overvalued, but of course, it's hard to know, right? They could crash tomorrow, and obviously I'd look pretty silly for saying that. So, but even if they're not necessarily overvalued, there is very good evidence that if you're comparing the stock market to GDP, that by like how expensive it is, that's at an all-time high. And crypto is at all-time highs, of course, too, right? As well as of course, real estate's really expensive, right? Most people can't afford homes. And so, like I mentioned earlier, the federal funds rate is what controls basically the amount of money printing, right? Because it affects how expensive it is to borrow money and to loan money. And so as this rate drops, there should be more loans going out into the economy and more people borrowing money, especially to buy things like homes. And as you can see here, been a huge, steadily declining fall from 1980 to, and especially the last 15 years, the federal funds rate has been near zero, which should be, leading to a bunch of money printing, right? And you would think a bunch of inflation, right? Because, in 1980, the inflation was 13.5%. Of course, today it's been very low, especially the last 15 years it's been very low, even though the rates are so much lower. And so I would say definitely part of that is, even though it's super cheap to borrow money, people still aren't buying money. Like people still aren't buying homes, even though it's super cheap theoretically to do so, which kind of, is a function of wealth inequality and, the wealth getting concentrated at the top, as well as I think, there is a lot of money printing going on, at these low rates, and we're just not capturing it in the CPI data. So, if we kind of go with where does this leave us? It basically, very simple conclusion, right? Wealth inequality is bad. And I think wealth inequality is bad, and you can see here, it's, the share of income has really trended towards the upper income segment, and middle income has trended down a lot, which is, I think it should be really intuitive to say that wealth inequality is bad. But people still make the argument that, there's no evidence that increasing wealth inequality is harming the economy, which hopefully, if you've been paying attention, there is plenty of evidence that wealth inequality is bad. And, if you go back to our alternate economy flow diagram, right, the reason for that is because the wealth should really be distributed equitably throughout society, right? And it shouldn't be just concentrated in the hands of a very few people at the top. And the reason for that is, kind of goes back to why democracy is the best form of government. Because, all the most successful economies, tend to be capitalistic as well as more liberal democratic societies. And the reason for that is because when you don't hoard wealth at the top, such as in a dictatorship, they often hoard most of the wealth at the top, you end up with more productivity because spreading the wealth amongst the rest of society, promotes innovation, it promotes technological advancement, it promotes, people want to be more efficient, it promotes investment, right, which leads to more wealth creation for all of society, and everyone in society, including those at the top, where counterintuitively by hoarding a smaller share of the wealth, they actually end up with more wealth overall. And yeah, I'd love to hear your thoughts about hidden inflation, and if you agree or disagree, as well as any ideas on what you'd like to hear me talk about next. So thanks for watching.